Monday, May 4th, 2026. Today might feel like just another normal day, but what I'm about to reveal could turn out to be one of the biggest financial shifts of this year. A silent transition that hasn't made headlines yet. But when it does, it may already be too late, because right now, at this very moment, money is moving differently, quietly, almost invisibly, and the people who recognize this shift early will position themselves before the real move begins, while everyone else will be left staring at charts, wondering how it all happened so fast. Because while the world is distracted by inflation debates, interest rate decisions, and stock market volatility, a completely different game is unfolding underneath, one that could decide the real winner of 2026. Gold or silver, and here's the twist. The story most people are hearing right now might actually be wrong, because the real narrative isn't happening on the surface. It's building underneath it, and that's exactly where smart money starts to move first. And if you want to understand these hidden shifts before they go mainstream, make sure you subscribe to Metal Market Insight right now, because this is where we break down what others overlook. And trust me, after today's discussion, you won't look at the metals market the same way again, because this isn't just about prices. This is about a shift in power. Now step back for a second and think about this. When the world becomes uncertain, where does money go? The answer has always been the same. Gold. For decades, gold has been seen as the ultimate safe haven. Central banks are still accumulating it aggressively. Governments continue to treat it as a monetary anchor, and investors rely on it as protection against chaos. And in 2026, that role hasn't just remained intact, it has actually become stronger. But at the exact same time, another metal is quietly stepping into the spotlight. And that metal is silver, and here's where things start to shift, because unlike gold, silver doesn't just sit in vaults, it gets used, consumed, and in many cases permanently removed from supply. And now the demand isn't just coming from coins or jewelry, it's being driven by electric vehicles, solar energy, AI infrastructure, and advanced technologies. And when a metal becomes both precious and essential at the same time, its entire market behavior begins to change. Now here's where the data starts to confirm the story, because over the past few years, global silver demand has been consistently outpacing supply, and in 2025 alone, industrial demand pushed total usage to record levels, with solar energy accounting for a massive share of that growth, especially in the United States, where aggressive clean energy policies and infrastructure investments are accelerating deployment at a scale we haven't seen before. And what makes this even more important is that silver isn't easily replaceable in many of these applications, meaning demand isn't just growing, it's becoming locked in. At the same time, supply isn't keeping up, and that's a critical piece most investors overlook, because unlike gold, which is often mined specifically for investment and reserves, the majority of silver production actually comes as a byproduct of mining other metals like copper, lead, and zinc, which means even if silver prices rise, production doesn't instantly respond, and that creates a structural bottleneck. And when you combine that with declining ore grades and limited new discoveries, the pressure on available supply becomes even more intense over time. Now bring this into the US market specifically. Because this is where the investment narrative is starting to shift, retail investors are becoming more aware of silver's dual role, not just as a hedge, but as a growth-driven commodity tied to real economic expansion. And at the same time, institutional interest is slowly picking up, especially through ETFs and commodity funds that are beginning to rebalance exposure toward assets with both defensive and industrial characteristics. And this shift may seem gradual on the surface, but historically, these are the early stages before momentum starts accelerating. And then there's the volatility factor, which is where silver behaves very differently from gold. Because silver's market is significantly smaller, even relatively small capital inflows can create outsized price movements. And we've seen this pattern before, where long periods of slow accumulation are suddenly followed by sharp upward spikes. And in a market environment like 2026, where liquidity, speculation, and macro uncertainty are all interacting at the same time, that kind of setup becomes even more explosive. But here's the part that really changes how you should think about this entire situation. Because the real opportunity isn't just about picking one metal over the other, it's about understanding timing and positioning. Gold continues to serve as a stabilizer, especially in periods of geopolitical tension and currency uncertainty. But silver is increasingly acting as a leverage play on global growth and technological expansion. And when those two forces collide, fear and innovation, you get a market dynamic that can create both protection and opportunity at the same time, but only for those who recognize it early. Now let's go deeper into something that most mainstream discussions avoid, and that's the structure of the silver market itself, because unlike gold, which trades in a much larger and more liquid global system, silver operates in a tighter environment where pricing can be heavily influenced by futures markets, short positions, and institutional flows. And over the years, there have been repeated concerns about price suppression an unusual trading behavior. And while opinions differ on how significant this is, what matters is this. When pressure builds in a smaller constrained market, the eventual release tends to be fast, aggressive, and very difficult to predict. This is exactly why timing becomes such a critical factor. Because in markets like silver, the biggest gains are often compressed into very short time frames, meaning that the majority of investors either enter too early and lose patience, or enter too late after the move has already started. And in 2026, with rising demand, constrained supply, and increasing attention from both retail and institutional players, the probability of a sudden repricing event becomes much more realistic than most people are prepared for. At the same time, you can't ignore the macro backdrop, because everything happening right now in the global economy adds another layer to this story. Persistent inflation concerns, shifting monetary policies, geopolitical tensions, and ongoing questions around the strength of fiat currencies are all reinforcing gold's role as a safe haven, especially in the United States, where investors are increasingly focused on capital preservation. And this is why gold continues to attract steady inflows even when other assets become volatile. But when you put both of these narratives side by side, something very interesting starts to emerge. Gold represents stability in uncertain times, while silver represents acceleration in transformative times. And right now, we are living in a period where both forces are happening simultaneously, uncertainty on one side, rapid technological and industrial expansion on the other, and this creates a rare setup where both metals can move, but in very different ways. And understanding that difference is where the real edge comes from. So if you step back and look at the bigger picture, the question is no longer gold or silver. The real question is how these two assets complement each other in a changing financial landscape. Because the investors who win in 2026 won't be the ones chasing headlines. They'll be the ones who understand positioning before the narrative fully shifts. And as momentum builds and awareness spreads, the window to act early starts to close. And when that happens, the move doesn't wait for anyone. Now let's break this down from a practical investor perspective in the United States. Because one of the biggest shifts happening right now is how portfolios are being restructured. Traditional 60-40 allocations are under pressure. Bonds are no longer delivering the same level of stability they once did. And equities are becoming increasingly sensitive to macro shocks, which is forcing investors to rethink where they place their defensive capital. And this is exactly where precious metals are regaining attention, not just as a hedge, but as a strategic allocation tool. Within that shift, gold continues to dominate as a core holding, especially among institutional investors, pension funds, and central banks, because it provides liquidity, stability, and a long track record of preserving value during economic stress. But what's changing in 2026 is that silver is no longer being treated as a secondary or optional asset. Instead, it's increasingly being viewed as a complementary position that can enhance returns without completely sacrificing the defensive nature of a metals allocation. Another important factor that's often overlooked is how interest rate expectations are influencing both metals. Because when real interest rates begin to stabilize or decline, the opportunity cost of holding non-yielding assets like gold and silver decreases, making them more attractive. And with ongoing uncertainty around Federal Reserve policy, inflation persistence, and economic growth projections, this creates a backdrop where both metals can benefit. But again, silver tends to react more aggressively due to its smaller market size and dual demand profile. At the same time, the role of the US dollar cannot be ignored because historically, a weakening dollar tends to support higher precious metal prices. And while the dollar has remained relatively strong in certain periods, any sustained shift in currency strength, especially in response to policy changes or global trade dynamics, could act as a catalyst for both gold and silver. And in that scenario, silver's upside potential often becomes more pronounced due to its higher volatility and sensitivity to capital flows. And then there's the behavioral side of the market, which is just as important as the fundamentals, because once a narrative starts gaining traction among retail investors, momentum can build very quickly, especially in today's environment where information spreads instantly through social media, financial platforms, and online communities. And we've already seen how quickly attention can shift when a specific asset becomes the focus of collective interest. And if silver begins to capture that kind of attention again, the resulting price action could be far more aggressive than what traditional models would suggest. Now, let's focus on positioning, because this is where most investors either gain an edge or fall behind. And in 2026, smart positioning is less about going all in on a single asset and more about understanding how different assets behave under different conditions. Gold tends to perform best during periods of fear, crisis, or monetary instability, while silver tends to outperform when economic activity, industrial expansion, and speculative interest begin to accelerate. And recognizing which phase the market is entering can make a significant difference in outcomes. One approach that is gaining attention among experienced investors is dynamic allocation, Rather than holding a fixed percentage in gold or silver, they adjust exposure based on macro signals, for example, increasing gold exposure when recession risks rise or when volatility spikes, and gradually shifting towards silver when indicators point toward recovery, manufacturing growth, or increased infrastructure spending. And this type of strategy allows investors to benefit from both stability and growth without being locked into a single narrative. It's also important to understand the different ways investors are accessing these metals in the U.S. market. Physical ownership remains a long-term strategy for those focused on wealth preservation, while ETFs provide liquidity and ease of trading for more active participants. And then there are mining stocks, which add another layer of leverage because they don't just track metal prices, they amplify them, but they also introduce additional risks, such as operational challenges, cost structures, and market sentiment, which means each approach serves a different purpose depending on the investor's goals. Another layer to consider is the timing of capital flows. Because large institutional money doesn't move randomly, it follows signals, trends, and risk assessments. And when those flows begin shifting toward a specific asset class, the impact can be substantial, especially in a market like silver where liquidity is lower compared to gold, and even a relatively small reallocation from major funds can create noticeable price movements, which is why watching flow trends and sentiment indicators can provide early clues about where momentum is building. And perhaps one of the most overlooked advantages right now is the gold to silver ratio, a metric that has historically been used to evaluate relative value between the two metals. When the ratio is high, it suggests silver may be undervalued compared to gold. And when it begins to contract, it often signals that silver is starting to outperform, and in recent periods, this ratio has remained elevated compared to long-term averages, which is one of the reasons many analysts believe silver still has room to catch up if current trends continue. Now take a moment to connect all of this, because what we're seeing in 2026 isn't just another cycle. It's a transition phase, a shift where traditional financial assumptions are being tested, and assets that once played simple roles are now evolving into something more complex. Gold is no longer just a crisis hedge. It's becoming a core reserve strategy in a world questioning currency stability. And silver is no longer just a cheaper alternative. It's turning into a critical resource tied directly to the future of technology and energy. And this is where long-term thinking becomes extremely valuable, because short-term price movements can be unpredictable, but long-term trends are often driven by fundamentals that don't change overnight. The expansion of renewable energy, the growth of electric vehicles, the increasing demand for high-performance electronics. These are not temporary trends. They are structural shifts, and each one of them requires silver in a way that is difficult to substitute, which means demand has a strong foundation moving forward. At the same time, global financial uncertainty isn't disappearing either. Debt levels remain high, geopolitical tensions continue to evolve, and confidence in fiat systems is constantly being tested. And this ensures that gold remains relevant, not just as a defensive asset, but as a strategic one, especially for institutions and governments that need stability in an unpredictable environment. And this dual reality, growth on one side, uncertainty on the other, is what makes this moment so unique. So from a strategic perspective, the real advantage comes from understanding balance and timing, not reacting emotionally to headlines, not chasing sudden price spikes, but building a position that can adapt, one that includes stability through gold and opportunity through silver, and adjusting that balance as conditions change, because markets reward those who think ahead, not those who react late. And in a year like 2026, that difference becomes even more important. And as momentum continues to build, one thing becomes clear. The biggest moves in any market rarely happen when everyone is paying attention. They happen quietly in the background, while most people are still focused on the wrong signals. And by the time the story becomes obvious, the opportunity is no longer the same, which is why understanding these shifts early isn't just helpful. It can be the difference between participating in the move or watching it from the sidelines. At this point, the real question isn't whether gold or silver will move, because both already have strong fundamental drivers behind them. The real question is who understands the timing of these moves before they fully unfold, because in financial markets, information is never equally distributed. And those who recognize shifts in sentiment, demand, and macro conditions early are usually the ones who benefit the most when momentum accelerates. If you look at history, major wealth shifts in commodities have rarely been random. They happen in phases where industrial demand, monetary uncertainty, and investor psychology all align at the same time. And what makes the current environment unique is that we are seeing all three of these forces developing simultaneously, especially in the United States, where technological expansion, energy transition, and financial uncertainty are all interacting in real time. And this is exactly why both gold and silver continue to attract attention from completely different types of investors. Conservative capital still flows toward gold because it represents stability and long-term preservation, while more growth-focused investors are increasingly watching silver because of its industrial demand and higher sensitivity to economic expansion. And this dual interest is what creates ongoing tension in pricing dynamics. So if you are watching this from an investment perspective, the most important takeaway is not to chase short-term noise, but to understand the broader structure behind these markets, because whether it's gold providing balance or silver offering acceleration, both assets respond to macro shifts that are already in motion. And the investors who stay informed, patient, and strategically positioned are usually the ones who navigate these cycles most effectively. If you found value in this breakdown, make sure you subscribe to Metal Market Insight, because we break down real market movements, not just headlines, and share this with someone who needs to understand where the metals market is really heading, because this information can completely change how they see wealth and timing in 2026. And remember, this is not about prediction, it's about preparation. This content is for informational and educational purposes only and should not be considered financial advice. Always do your own research and consult a qualified financial professional before making any investment decisions.